Let's take a look at option 2 today. So we're going to look at the options for securing financing for the AAT, the exchange accommodation title, and reverse exchange, right? Basically, you are guaranteeing a loan to the AAT. The loan is made by a third party. This option involves leveraging the financial strength of the third party guarantor, which is you, to secure funding for the AAT. First, why might you consider this option? Well, it's important to understand that most mortgage lenders and banks are hesitant to loan money to LLC, especially an EAT, because they might hold the property, but they're going to hold it temporary, right? So if you go to the bank and you tell them that, we're going to do it temporary with no guarantee, they're going to be very, very reluctant to loan you the money. Because this AAT is basically like a shell, like a holding company. So it lacks assets or a borrowing history because probably was just established yesterday, right? And very few lenders are familiar with the different parts of the reverse exchange strategy. They might not even never heard about it. And now you come to them and tell, hey, this is my strategy. So they're going to be like, okay, this might be too risky for us. So how do you overcome this, right? You can overcome this if you can provide a personal guarantee for the loan made by the EAT. By providing guarantee, you essentially vouching on repayment of the loan, right, on behalf of the LLC, the EAT. This might give the lender, the bank, like some assurance level that they gonna feel more comfortable to loan you the money, right? So increase your likelihood of being able to secure financing. In some cases, the exchanger, which is you, might also offer up additional collateral to further strengthen the loan application. So if you have any assets, like if you have another house, another rental, that like a business or other kind of assets, a lot of time they could even collateralize their investment portfolio, their securities, stock bond. You could talk to the bank and see what would be the valuable assets for that bank that they want to choose as the collateral. Basically, you can talk to them and see what works best for your case. This kind of collateral serves as additional form of security for the lender. They feel more assured because of the EAT's borrowing capacity may be limited. When guaranteeing the loan by a third party, it can be effective financing option for the EAT. So you want to make sure that you consider all the risks involved, right? Because if the deal go through or something go through, or your collateral assets, maybe the bank gonna want to hold you to your promise, right? So you definitely need to pay them back their principal and interest, right? And any fees associated with that. So make sure that you fully understand the loan terms and what you're signing up for, right? It's because it's your money. If you don't safeguard, nobody else will. And again, if you consider this option, it's also advisable to consult with your qualified intermediary and also your financial advisor, your lender, your mortgage lender, to assess the suitability of guarantee for the loan for the EAT and your specific circumstances. So with their guidance, you can make more informed decisions and navigate this effectively. With that, so let's move on to the third option, where we would do a combination of the two approaches.